Suppose three investors each begin with $100. Each owns the same market. Each starts with the same chance to win or lose. Then the market moves. The first investor does nothing. If stocks rise, her stock weight rises. If stocks fall, her stock weight falls. She lets the portfolio drift. The second investor keeps restoring a fixed mix. If stocks rise, she sells some stocks. If stocks fall, she buys some stocks. She leans against the move. The third investor uses portfolio insurance. If stocks rise, she buys more stocks. If stocks fall, she sells stocks. She leans with the move. Same assets, same market. Three different trading rules. Andre Perold and William Sharpe showed that these rules are not minor details. They are three different payoff shapes. Straight, concave, convex. That is the lesson. Your rebalancing rule is not bookkeeping. It is a bet with a shape. This mattered because Wall Street had just learned that lesson the hard way. In the 1980s, institutions wanted the upside of stocks without the full downside. Portfolio insurance promised that result. It tried to create an option-like payoff through trading, not by buying a listed option, by moving money between stocks and bills as the market moved. The idea sounded elegant. When the market rose, the strategy bought more stocks. When the market fell, it sold stocks. The goal was to keep the portfolio above a floor. By 1987, large institutions had committed tens of billions of dollars to these programs. Then came October 19, 1987, Black Monday. The United States stock market fell about 22% in one day. Portfolio insurance tried to do what it had promised. It sold into the fall. But the market was already falling fast. The selling added pressure, and prices moved faster than the models assumed. Some portfolios fell straight through their supposed floors. The insurance failed when it was needed most. After that, investors had a deeper question. Was portfolio insurance the problem? Or was dynamic rebalancing itself the problem? Should investors still rebalance a plain 60-40 portfolio? Should they buy dips? Should they chase trends? Were these all just different versions of the same hidden trade? Perold and Sharpe did not answer with a backtest. They gave investors a map. The map starts with 4 rules. The first rule is buy and hold. You choose a starting mix, then you stop touching it. If stocks rise, the stock weight grows. If stocks fall, the stock weight shrinks. You do nothing. The second rule is constant mix. You keep restoring a target weight. If the policy is 60% stocks and 40% bills, you trade back to that policy after the market moves. Stocks up, sell some stocks. Stocks down, buy some stocks. This is the habit behind many balanced funds, target date funds, and automated accounts. It feels like discipline, but it is also a market view. The third rule is constant proportion portfolio insurance. People usually call it CPPI. CPPI starts with a floor. The floor is the minimum value the investor wants to protect. Then it defines a cushion. The cushion is portfolio value minus the floor. The rule invests a multiple of that cushion in the risky asset. So if the portfolio is worth $100 and the floor is $80, the cushion is $20. If the multiplier is 3, the risky exposure is $60. Now suppose the portfolio rises to 110. The cushion becomes 30. 3 times 30 is 90. So the strategy buys more stocks after the gain. Suppose the portfolio falls to 90. The cushion becomes 10. 3 times 10 is 30. So the strategy sells stocks after the loss. That is the core behavior. CPPI trades with the move. The fourth rule is option-based portfolio insurance. It tries to combine a safe asset with an exposure that behaves like a call option. A call option benefits from upside while limiting downside to the amount paid. All 4 rules can be compared with one picture, a payoff diagram. On the horizontal axis is the final stock market level. On the vertical axis is final portfolio value. The diagram asks a simple question. If the market ends here, what did this rule leave us with? Once Perold and Sharpe drew that picture, The pattern became clear. Buy and hold is linear. The line is straight. The investor does not trade after prices move, so the portfolio carries its original shares forward. It neither fights the market nor follows it harder. Constant mix is concave. That means the curve bends downward. The reason is simple. When stocks rise, constant mix sells some of them, so it owns less of the winner on the way up. When stocks fall, it buys more of them, so it owns more of the loser on the way down. That sounds bad in a trend. And it can be. But in a choppy market, it can work. If the market rises, and falls again, constant mix keeps selling high and buying low. The back and forth movement becomes fuel. CPPI is convex. That means the curve bends upward. When stocks rise, CPPI buys more. When stocks fall, it sells. It rides the trend instead of leaning against it. That can work in a strong bull market. It can also help if a decline is smooth enough for the rule to cut risk before the floor is hit. But it has a weakness. If the market gaps down, there may be no chance to sell in time. That is the old portfolio insurance wound. So the headline result is not complicated. Do nothing, and the payoff is linear. Sell winners and buy losers, and the payoff is concave. Buy winners and sell losers, and the payoff is convex. The brand name matters less than the direction of the trade. Now let us put the formulas on the board. For CPPI, risky exposure equals M times the maximum of portfolio value minus the floor, or 0. In words, risky exposure equals the multiplier times the cushion. Here, M is the aggression dial. Portfolio value is the current value of the account. The floor is the value the investor wants to protect. The cushion is the distance above that floor. This formula is powerful because it changes exposure as wealth changes. When the cushion grows, risk grows. When the cushion shrinks, risk shrinks. That is why CPPI buys strength and sells weakness. For constant mix, risky exposure equals W times portfolio value. Here, W is the fixed risky weight. If W is 0.6, the rule wants 60% in stocks. If stocks rise and the weight becomes too high, the rule sells. If stocks fall and the weight becomes too low, the rule buys. So constant mix is not just safer sounding rebalancing. It is a volatility position. It likes reversal. It dislikes one-way markets. This leads to the paper's most elegant idea. Concave and convex strategies are mirror images around the buy and hold line. One sells into rising markets. The other buys into rising markets. One buys into falling markets. The other sells into falling markets. They are opposite sides of the same trade. That means these strategies need each other. When constant mix investors trim stocks after a rally, someone must buy those stocks. When CPPI investors sell into a decline, someone must take the other side. If everyone tries to run the same dynamic rule, the rule loses the market structure it depends on. Perold and Sharpe made the point sharply. Only buy and hold strategies can be followed by all investors. That line is more than clever. It is a market constraint. Concave and convex strategies are relative positions. Their costs depend on how crowded they become. Now bring this into today. A rebalanced retirement fund is usually a constant mix habit. It trims winners and adds to losers. That can be good in noisy markets. It can be painful when stocks and bonds trend down together, as they did in 2022. A principal-protected note often hides a CPPI-like structure. It buys more exposure when the cushion grows. It cuts exposure when the cushion shrinks. The floor is valuable, but it is not free. A trend-following strategy sits closer to the convex family. It adds to strength and cuts weakness. It can look foolish in chop and brilliant in trend. The point is not that one shape is always best. There is no always best shape. The point is to know what market your rule needs. Think about a simple choppy year. Stocks start at 100. They rise to 120. Then they fall back to 100. Then they rise again. Then they fall back again. Buy and hold sees noise and ends near where it started. Constant mix sees trades. It trims after the rise. It adds after the fall. If costs are low, the motion itself can add value. Now think about a clean bull market. Stocks start at 100 and keep moving up. Constant mix keeps selling the thing that is winning. That is not a mistake. That is the shape. The strategy is designed to keep risk constant, not to maximize participation in a trend. CPPI has the opposite experience. In the choppy year, it can get whipsawed. It buys after a rise, then suffers when the market reverses. It sells after a fall, then misses part of the rebound. But in the clean bull market, CPPI looks smart. The cushion grows. The risky exposure grows. The rule presses the winning side. This is why the paper is still useful. It does not promise that one rule will win. It tells you what kind of market each rule is asking for. It also changes how you hear common product language. When a fund says it rebalances on a schedule, ask how wide the bands are. Tight bands mean more constant mix behavior. Wide bands mean more drift. When a note says it protects principal while offering equity upside, ask what happens after a drawdown. If exposure falls when the cushion shrinks, the investor may be protected, but may also miss the rebound. When a strategy says it follows trends, ask how it behaves in sideways markets. Convexity is not free. It often pays for its crisis or trend payoff by bleeding in chop. The paper gives you a calmer vocabulary. You do not need to say a rule is good or bad. You can say what shape it has. Then you can ask whether that shape matches the market and the investor. That is a better question, and it is much harder to fake. There are 4 catches. First, gap risk. CPPI assumes you can trade as the cushion shrinks, but markets can jump. If the price gaps through the floor before trades happen, the floor can fail. Second, transaction costs. Constant mix can harvest reversals only after paying spreads, taxes, and market impact. Too much rebalancing can turn a good diagram into a mediocre result. Third, crowding. If too many investors use the same rule, the trade becomes expensive. That is part of what made portfolio insurance dangerous in 1987. Fourth, path dependence. 2 markets can end at the same level and still create different outcomes. The path matters because dynamic strategies trade along the way, so the practical lesson is plain. Before you ask whether a strategy is smart, draw its shape. Is it linear? Is it concave? Is it convex? Does it want drift? Does it want chop? Does it want trend? Your rebalancing rule is the shape of your wealth curve. Perold and Sharpe showed that buy and hold is linear, constant mix is concave, and portfolio insurance is convex. That is why modern funds and structured notes still carry hidden market-shape bets. Before you ask whether a strategy is smart, ask what kind of market it needs.